Welcome to Subramani. The January 2022 has not been a very great start for most of the people who have been in the markets, right? The dreaded C word. There are three dreaded C words. Earlier, once upon a time, it used to be only cancer. Now it is cancer, and then it could be COVID. And for the people, the worst thing that can happen in the market is correction, right? So three dreaded C words to start with. So first of all, what happens in the market when the market falls, and what are the type of falls that are there? First of all, there's a small fall of say 3%, 4%, maybe 5%, which is which what you could call is a correction or a pullback, right? Just a small time correction, which is a pullback. But what happens today when market falls by say 5%? Let's say 60,000 rupees, 60,000 is where the Sensex is at today. Maybe it's at 58,000, but for calculation purposes, I'm saying 5% is 3,000 points. So the market may not fall 3,000 points in a day, though of course it can fall 3,000 points in a day. But if it falls say 800, 1100, 1,200 and totaling it, let's say it totals up to about 3,000 points. What will happen is suddenly you will find articles in the press saying, is the market over? Is the rally over? 3,000 points is huge. Somebody who entered the market last week has been completely wiped out, or some such nonsense would be there in the market. And it may not mean anything. It may just mean that the market is gone back by 15 days. Right? In 15 days, the market went up 3,000 points, but it lost 3,000 points in 3 days. This normally happens, like one famous investor says, Rome was not built in a day, but Hiroshima and Nagasaki were destroyed in a day, right? I think it's Vijay Kedia who says that, which is so true because it takes a long time, it maybe taken me 40 years to build my portfolio. And it could take me 15 days of F&O trading done very badly to completely ruin it, right? I've seen such cases. So you don't want to do something like that. But no, correction over 3,000 points on the 60,000 index means nothing. It just okay. Somebody was over optimistic. They bought, did not have the money, so they gave delivery. Or somebody says, okay, let me take my profits. I bought at this index and I want to sell. घर में बेटी की शादी है, घर खरीदना है, ऑफिस खरीदना है, anything, right? Enough reasons why investors will also sell. It is not as though investors will keep holding for the rest of their lives. They are also keeping money away in a particular asset class called equity, where from they will remove whenever they need money, right? It's as simple as that. So if you are investing in a place, a farmer in Himachal Pradesh wants to buy some extra farmland, he sells off his Infosys and buys it. It does not mean that it's the end of the road for Infosys. Oh, everybody should sell Infosys. Not true. He needed money, so he sold about 1 crore worth of Infosys and bought some Apple farm. Now, does it mean that everybody should sell their Infosys and buy Apple farm? No. So these are all contributions which will all happen. Maybe 3-4 such transactions, 10 such transactions, 100 such transactions happening, and all could have some impact on the market, and that could be a small correction. That is called a small correction of say 5%. The other thing which could happen is there could be a 10% correction where there is more sell-off, which could happen because some problem in China, some problem with metals, oil prices have gone up, interest rates, some things have changed, right? So, and it could happen any part of the world. Now, when you are talking of a 5% correction or a 10% correction, it could happen to the Nasdaq, it could happen into US stocks, it could happen into Indian stocks, it could be anywhere. If you are invested say 80% in India and 20% in US, the Indian impact happening in Indian markets will be greater than the impact of Nasdaq falling or S&P falling, right? Or you may find that S&P has not fallen but only Nasdaq has fallen, or S&P has fallen but Nasdaq has actually gone up. All these things are possible. Now it depends on your portfolio, where it is invested and how much it is invested. So whenever you see a 5% correction or a 10% correction or whatever it is, you see as a broad headline, it means the market has fallen. Your own shares may not have fallen so much, or your shares may have fallen more than that, right? Any of these things are possible. So you have to find out that yes, these things will happen, and it is not that these things never happen at all. They will always happen. And sometimes these corrections are healthy, because sometimes you want the markets to come down so that you are able to buy, or somebody else is waiting to buy, right? All these things can happen. So remember one thing, if you are a long-term investor, there are certain things which I want you to remember. One, pullbacks are common. Don't think that once you have bought, the market won't fall, or once you have sold, the market won't go up. Market does not even know you. Market does not know that you exist. You know that the market exists. Market does not know that you exist. So markets up and downs will happen. If you sit down and properly take note, there will be enough data available somewhere. How many such pullbacks would have happened in the last 5 years of your investing life? If you have invested for 1 year, just see how many times the market has fallen or gone up by 5% in a day. May not be too common, but 5% could be there over a 3-4 day period, right? So it could be a 3% fall, 4% fall, but quickly recovering, and right, those things could happen. You know, these are small corrections, right? Aberrations, as we should call them. The market moves very differently from how you think the market should move. There will be small fluctuations always, right? I typically tell people that if you know a man walks from one place to another every day with his dog, that is how the economy moves, in a straight line, how he goes. How the market moves is how the dog moves. The dog does not move in a straight line with him. It will go there, it will come back, he'll be, even if he's holding on a leash, it will sniff somewhere, it will go up, down. So it will keep doing this, right? So it's going to the same place. If you want to know where the dog goes, follow the man. Right? Don't have to follow every move of what the dog does. The dog will keep doing ups and downs, right? So that is how the market does. You watch the economy if you really want to watch how the market will go, and the market will go exactly the same place. Now when I'm saying economy, I mean if you want to watch where TCS is going, you look at the TCS results. If you want to watch where Biocon is going, you see what Biocon is doing. If you want to know where LMW is going or Happiest Mindset is going, you look at what the company is doing. Don't look at the share price. Okay, small digression, but yeah, that is how you have to look at the company will tell you where it is going in a straight line, up, down, whatever, but the dog will keep doing these ups and downs. Remember, these pullbacks or falls are good. Smart investors know that this is a great time to be buying. So let's say you wanted to buy Hindustan Aeronautics at 1450 and you thought it was too high. There was a correction, market came down to 1280. Great time to be buying. But that is after you have decided that you want to buy Hindustan Aeronautics. I am not recommending LMW or Hindustan Aeronautics. You may have guessed these are in my portfolio, but I am just saying that you wanted to buy at this price. The market has come down a little. It's a great time to be buying. You don't know whether to be buying or selling. You just wait. Once you have decided that this is I want to sell Hindustan Aeronautics at 1400 and you find that it went from 1450 to 1540, great time to be selling. You have to sell on rise and buy on dips. Depending on your, first you decide whether you want to buy or sell, then you decide how to act when the market goes up or market goes down. Pullbacks are quite common. Don't think that it is happening unique just after you bought. It has always been happening last 30, 40, 50, 100 years that markets have existed. Pullbacks happen. Right? Remember one more thing, corrections can be fast, and the speed at which it happens, if you are on the wrong side, it can be brutal, right? It can be very quick. So don't think you can act on it. Very unlikely, unless you've already put in a transaction. Suppose you have been tracking Hindustan Aeronautics, it was at 1480. You wanted to buy it, so very ambitiously you went and put a buy at 1280. You knew it will not go there. Maybe you thought that was a good price to buy it at. You put buy for 100 shares at 1280. On that day there was some brutal correction in the market. All PSUs were hammered and it came to 1280. You would be lucky to get it. It's not that every day you will be you will be able to get it, right? So on the other hand, you were very happy that LMW had done very well yesterday. So it was 11,200 and you thought, well, if it goes to 11,500 I want to sell. So you put a transaction at 11,500 to sell and it actually went up, right? So it is possible that some things like this happen, but that is luck. It's not to say you got the top or got the bottom. 6 months later it could be at 15,000 or it could be at 9,000. So depending on whether you bought or sold, you could look very dumb or very smart. So don't get carried away by that. But corrections can be brutal and fast. Very rarely will you be able to benefit from that unless you accidentally happen to be there, right? Like you accidentally happen to be there with your umbrella and it rained. That's all. It's just like that. Don't treat that as a day-to-day happening. It was just luck. One-off transactions can happen like that. Corrections happen largely because of fear and speculation. A tells B, B tells C, C tells D, and there could be story. So everybody keeps on buying some particular share and the share goes up. That could be just speculation, and afterwards at some stage fear comes in, so somebody sells and it comes down. So fear and speculation, many a times these corrections are a little healthy for people either entering or exiting. If the market goes up suddenly, maybe it's a good time for some people to exit, or if the market comes down, maybe it's a great opportunity for some people to enter. So these fear and speculation leads to creating entry points for some people who are small time traders coming in and going. If you're an investor, you don't have to worry. Right, the markets will keep doing this kind of stuff. So this such a sell-off is healthy for many people. This is a time to be entering. So it is good. However, remember that it could be a little challenging for retirees. If you are retired and you are afraid that there may not be enough time for the correction to. For the retirees, it could cause some stress, saying what happens if the correction is not fast enough for me? If I'm say 85 years of age and then the market falls, will I have enough time for the market to correct and for me to benefit? That's a difficult question to answer. Therefore, by the time you're 85, you may be only 15% in equity, just going by the old thumb rule. And in that 15%, if you see a 10% fall, it means 1.5%. So in your net worth, a 1.5% fall should not bother you too much, or you should have enough of the of money in bank fixed deposit and annuities that any fluctuation in your equity should not be bothering you at 85, assuming you're actively looking at your portfolio. Otherwise, your whole portfolio, the fluctuation may not be too much. But if you are younger and retired, let's say you're 72, 73, and you have a lot of money in equities, let's say you have 50% in equities and 50% in debt, then a fall can hurt you more. So therefore, when you're younger in retirement means age of 60 to 80, right, 60 to 75. When you're younger and in retirement, you need to have a very good plan to handle market falls. Now, these are all the places where a good advisor comes in and says, this is what you should do and this is what you should not do. Now, either you are an expert and therefore you're doing it DIY, doing it yourself, or you think that you can handle it yourself. Handling such situations, it is nice to have an advisor. At least I have one, so you make your choice. Thank you.